All right, and we should be live. Welcome to Thoughtful Money, folks. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here for a special Sunday live cast with Thoughtful Money's endorsed precious metals provider, Andy Schectman, the CEO of Miles Franklin. Andy, how are you, my friend?
Adam, Happy New Year, brother. Good to be here. Sorry I'm not in the studio today. I've got a house full. I got two of my three kids here, and each one of them has two or three friends here. So I still have a house full of kids, and one more day left before everyone heads out. So I figured I'd do it from home here today.
No, it's quite all right, and that's the best part of life is when you still have a lot of life in the household like that. So enjoy it. And
yeah, it is.
You.
It's you miss them like heck when they're not here. Then when they're here, you love them. But it's like, is it time to get out of here yet? Well, not there yet. Almost.
So this new neighborhood I live in has older folks in it, and so a lot of their adult children visited for the holidays, and that seems to be the whole story on the block. Great to have him here, but man, couldn't wait for him to leave.
Yeah.
Well, anyways,
no, it's a blessing.
But thank you for making time for our audience in the midst of all that. Everybody else watching, Happy New Year to you all. I see folks watching already from around the world, Norway, a few other countries here. A couple of things just before we get started and get to the central question of today's discussion with Andy, which is going to be, after hitting something like $83 an ounce a week ago in the futures market, silver corrected, by about 15%. It's last count had risen a bit above that. But the big question on everyone's mind right now in the silver space is, did silver just peak? And so Andy and I are going to talk about that in just a second. Real quick, a couple of things. One, I'm noticing my face here on the camera, and folks, you might see some darker spots on my face. Reason for that is I had my first dermatological, full skin scan in years, and actually it went quite well. But they did find a couple of spots on my face they wanted to blast with the cold freeze to clear up. So, anyways, I didn't get in a fight.
Well, just as an aside, that's not what this is about, but I'm going to mention it just because.
Go for it.
I live down here in Florida, and I've always been fairly olive skinned, dark complected. I don't need to go. I said to my wife, I don't need to go. Come on, you're going. So fine. I go to the dermatologist with her, and the dermatologist, you're in your underwear, basically. It's a 2-second thing. They did, and she's like, you're perfect. Wait. She says, you got this little tiny thing that I don't really love, and it's on the back of your shoulder. Now, if you're living by yourself, you're not doing something like this, you're never going to catch it. And they test it. Comes back stage 4, highest level of abnormality before it becomes cancer.
Whoa.
And she said, it's got to go. Well, it did, and then it's gone. But, the point of it is that I play a lot of golf, but I'm not walking around here sun tanning. So it's not even that this is getting an inordinate amount of sunlight on my shoulder blade. Get tested, man. I'm glad you said it, and you never know. Maybe just one person hearing this will say, fine, I'll go get tested. It takes 5 minutes and it can save your life. So just thought I'd say that.
I very much appreciate you sharing your own personal story there. So Andy, you probably don't know this, but on this channel recently, I've mentioned that since I moved to Nevada, I've ended up getting a concierge medical doctor, which is great. And I won't go into depth about it because I have before, but it's actually not even that expensive. And what he's doing with me right now is just going through the list of things that could kill a man in his mid-50s. And now we're down to the skin cancer part of it. And what's great about it is one, someone's there looking at you. A lot of this stuff is diagnostic. As you said, it doesn't really take that long. And oftentimes these tests don't really even cost that much. But we've already ruled out a lot of heart conditions. We've ruled out a lot of different types of cancer. We just ruled out the skin cancer thing. I'm not looking forward to it, but I've got my first colonoscopy ever coming up. But basically it's like the diagnostics on a car. And then once we have a baseline, then we kind of know what to treat or what just to focus on preventatively. Unfortunately, in my case, knock on wood, the results have been coming back largely negative, and I hope to keep it that way. But I got to tell you, the peace of mind of just knowing this, at my age, and I'm going forward in the next couple of decades of my life with pretty good baseline, even just the peace of mind alone has a lot of value. But of course, if I'm catching anything, That's really important. And my wife is sort of like you, Andy. She takes great care of her skin. She's already had 2 melanomas removed from her, which anyone who knows that procedure, it's not all that fun. I mean, they really take a big divot out of your back or your body, wherever they find it. It's kind of ironic that despite these little spots that they went after, I asked her for like, well, what's my letter grade here for, guy in his mid-50s? And she's like, oh, A, you're doing great. And the irony is like, I don't use nearly enough sun. I don't wear sunscreen that often. I should wear it a lot more. I should take much better care of my skin. My wife, who's been doing it for decades, is the one who actually hit the melanomas. So sometimes it's there's no rhyme or reason to it. A guy who probably should get it, like me, who's fair skinned and doesn't take great care of his skin, should get it. Thankfully, I don't have it. But to your point, an olive skin guy who wears shirts out in the sun still found he had an issue. So to your point,
where the shirt covers, not my arms, not my face, not my ears. Yeah.
So there's no real rhyme or reason for folks, to Andy's point, go get tested. All right.
Yeah.
Sorry, folks, didn't mean to turn this into a total skin cancer public service announcement, but whatever. Okay, we're going to get to the question in just a second. I also just want to note, Andy, I had a really interesting experience the other day. I got to be a little coy about when and where I did this, but I got to spend time with a collector of not just precious metals, but some other very rare minerals. Super interesting experience. I hope to be able to talk about in more detail. But at the meeting, he introduced me to a mining CEO, precious metals mining CEO and geologist. So of course, we spent a lot of time talking about what's going on with silver and what's going on with precious metals in general. And the mining CEO has been in the business for decades. Said, hey, I don't know where silver's ceiling is, but he said I'm pretty positive that it's got a new floor of at least $50 from here. So even people in the industry are, who have been tracking these prices for decades as part of their career of pulling it out of the ground, are basically saying, what this metal was just structurally underpriced by the market, and that is being corrected now. Now, in terms of how high it can go, he had no idea. This guy also spent a lot of time talking to Eric Sprott, who I'm sure you're familiar with, Andy, and just sort of channeling Eric. Eric is a lot more bullish than he is. He's kind of in your camp, Andy, thinking, hey, this train ends with certainly triple-digit silver, and before the party ends, we could see 200 at some point in there. So anyways, just wanted to share some very recent industry insight that I got here. But to the key point of this discussion here, do you think, let me put it this way, has silver peaked? Did we see the blow off top? Maybe we're going to find some new baseline. Maybe it's 50, maybe it's 60, maybe it's 70. But we're not going to get into triple digits anytime soon. That is the question on people's minds right now. Do you have a strong opinion one way or the other?
I would say to you, we have not come anywhere near peaking. It could be a short-term peak. Look, we've had, within 2 weeks, we've had 2 big margin increases. Now let's talk about what that is first and foremost. The margin increases, especially coming in thin holiday trading, which would amplify it more than anything, is designed, in my mind, to flush the weak hands out. What's more startling to me, and I'll come back to this in a second, is the amount of deliveries that we're seeing, which we're going to talk about. I had lunch the other day with, geez, I don't think there's any problem with me saying this. I had lunch with the owner of the New York Mets the other day, Stevie Cohen, who's a big hedge fund guy. And I went to his house for lunch. He lives very close to me, and interesting man, phenomenally interesting man. We talked baseball the whole time. We talked baseball cards, my baseball cards. We talked baseball cards for an hour. We didn't really talk about economics. The reason I bring it up is he lives in the neighborhood. Mark Wahlberg is his neighbor. Alicia Keys down the street. These houses are $35 to $50 million. Do you think they care what the mortgage rates are? These people come in there and pay cash. Now, what I'm saying is that what the CME did is what they always do by raising margins on December 31st by 30%, and a few weeks earlier by 10 or 15%. It flushes out the weak hands who come in on margin, who wanted to capitalize on a silver market that's moving parabolic. Now, this is easy pickings for the big banks. Forget about the major trend. It has nothing to do with the trend. This is I'm going to scalp you because you think you're smarter than the market is and you're not big enough to play in this sandbox. So here's what we do. All of you who went on margin to buy more silver at leveraged silver in order to make money, we're jacking up the fee, the margin that you have to have within your account. And so we're going to jack it up to a level by where it's going to put some severe pain on your pocketbook. And if you don't pay that margin, if you don't do that right away, why then you are going to have your position liquidated, which happened. And let me see how many. The first time they did it, the amount of, so we saw 13,430 contracts sold in 15 minutes. That was the first one on December 12th.
Wow.
The 26th, they followed up with the second increase. Sorry, I thought it was the December 26th, day after Christmas. And they rose the margin up to $25,000, a $3,000 increase. But you saw huge, in other words, you have to have $25,000 to own a contract in your margin account. And so what happened was all of these contracts got liquidated. Well, who do you think came in there and bought it all? Well, the banks just come in and buy it all, scoop it up on the cheap. It's called shaking the bushes. And it was done magnificently. You could argue that this was textbook. The speculators who come late, who think they're smart, who come in unleveraged, the big houses just shake the bushes real quick, and out comes all of the silver that they get to pick up on the cheap. I don't think it's the top at all. I look instead at one of the biggest anomalies that anyone has ever seen. Let's talk about Christmas. The total COMEX delivery notices as of December 26th, or in fact, the end of December, 62,875,000 ounces, record high for December of all time. Now ask yourself, who's taking possession of 62,875,000 ounces? We can look at the January 5th delivery report where Deutsche Bank, now there's a rumor out there that the European banks are in hot water. Mm-hmm. And I talked with you about this.
Sorry to interject, but you've told us in previous appearances that you believe the U.S. banks, especially the J.P. Morgans, have flipped from being net short to net long, and the ones that are still sort of stuck long were the European banks. So this
well, that's what the Economic Times said. Now, that was an article, and it's interesting. One of your subscribers, one of your followers sent me an email, said, I can't find it. So he and I go back and forth, and if you put it into ChatGPT or one of the search engines, it says, yes, indeed, this article is real. This article was published. You go to the Economic Times site, it was pulled. It says this is no longer here.
Oh, wow,
interestingly really? Enough. But one of your subscribers and I had a nice conversation back and forth about this, and we validated that it was there, that what I read and what other people talked about was real, and then they pulled it. Anyways, Deutsche Bank on January 5th issued, in other words, they delivered 3.27 million ounces. And who are the buyers? J.P. Morgan and Citigroup. They are the largest derivatives holders on the market. Now, when I say J.P. Morgan has flipped, according to the Economic Times, that doesn't mean that they don't have short contracts. They do. It just means that they're net long and exposure to more long than short. Mm-hmm. Which is a big rarity. But the bottom line with all of this is that the deliveries coming by the most sophisticated, well-funded traders in the world who are not using leverage, that is more important than anything. Yes, you can talk about the fact that it has been classified a critical mineral. Huge. You can talk about the fact that the European Union did it at the end of 23. Huge. You can talk about the Chinese export restrictions. Huge. But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month for going on 15 months now, that tells me that we are nowhere near the top. But you have end of quarter, end of month, end of year, selling, balancing books, taking profits. There's something on COMEX that is called Section 1256. Most people haven't heard of it. It basically says if you trade gold or silver futures on a registered exchange like COMEX, that you, no matter how long you hold the trade, it could be a day, it could be a week, it could be minutes or hours. When you sell it, the IRS automatically treats 60% of the gain as long-term, 40% as short-term. And that's a very big deal for active traders, of course. And of course, at the end of the year, the IRS also assumes that all open futures positions are marked to market. So there's a lot of, they can sell it, book it, buy it right back, and it doesn't trigger the wash rule. 30-day wash rule is something in securities that says if you sell a security for a gain, you can't buy it or anything else like it, or a loss, excuse me, more appropriately a loss. A very wealthy person sells a rental property for a big loss to offset a gain on Apple stock or something. You can't buy that or something similar back to it for 31 days. So in any case, all I'm simply saying is that there are a lot of things happening at the end of the year, whether it be shaking the bushes, huge deliveries, rules on COMEX that kind of make traders clean the books and then come back in. And then, of course, we have some other things that we'll get into about silver that I think are going to make this month incredibly volatile. The rebalancing of portfolios, where silver has gone up so high, it's now a disproportionate share of portfolios has to be rebalanced. At the same time, you got hedge funds, the January effect, they call it, coming in with all this cash. What are we going to buy? How about the best performing asset of 2025? Now that just got hammered down because of rebalancing, because of all of these things. No, the deliveries expose the rhetoric that these players who are standing for possession of billions every month are not doing this for the hell of it, Adam. It's just beginning. But to think it will be easy is fooling yourself. It will not be easy.
Okay. And by will not be easy, I'm presuming you more mean volatility, which is there's going to be a lot of shaking of the bushes here, and you want to hold on as best you can through it.
Right. The physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved, playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January.
Okay. Couple of things. First off, Thomas Rediker here just reposted this stream. Again, folks, I keep forgetting to figure out how you can repost, but apparently you can. So if you're watching and you know how to repost this stream, please repost it like Thomas did. It just helps get more and more people watching this stream, especially while we're doing it live. Also, something else that we should have mentioned right off the bat, which I apologize for forgetting to do, is Andy, you have been very kind in offering to this audience the exclusive offer of being able to purchase junk silver from Miles Franklin for $1 under spot, great pricing, while supplies last. And just heard from you before we hopped on here that supplies have now been consumed of being able to get junk silver at that price. That said, you're still able to offer it at a very attractive price. And again, this is all being influenced by not just people taking advantage of the offer, but by the margin hikes that you just discussed. So what is the current offer for viewers here that would still like
to and I'm going to also explain how I was able to do that. Let me tell you real quick what it will be. Again, and it's very fluid. That's what I want people to understand, that it's very, very fluid. I can do it for your subscribers for $1.49 over the price of silver. It's nowhere near what it was. But it's still pretty darn good. In fact, you know what? Let's call it $1.35 for right now until I can change. Now, let me tell you why I was able to do that for a very long time. And I went around for the last several months buying everything I could find in pre-65 silver. We have a network of a lot of, small and mid-sized coin shops around the country that will sell to us because they don't hedge their position, and we'll take it when someone comes in. But here's what's happened. So you have a network of traders around the country, or dealers, thousands of small dealers, coin shops, pawn shops, all that stuff. And they will take in pre-65 silver. And let's just say for a period of time, there was more selling in the public than buying. And I've talked a lot about how premiums were low, making it advantageous for people who were able to take advantage of these low premiums. And this has been going on for a while now. So the dealers who aren't sophisticated like the bigger companies, and I say that from a standpoint of business operations, not their intellect, but being able to hedge. So if I have 3 million ounces of silver in my warehouse, like I will quite often, I'll hedge it. I'll sell short 3 million on paper. So if silver, I have 3 million ounces and it drops by $10, I'm down $30 million. I'm screwed. But it goes up on exactly the same amount on what I sold short on COMEX. It allows me to be market neutral. That is what COMEX was designed for. Okay, so imagine you have all of these dealers who don't hedge and they don't have anyone buying it. So what do? Every week they will go to their local refiner and sell it to the refiner, who will melt it down into bars. And the refiners have been loaded up on bars and on candlesticks and on jewelry and on all sorts of stuff, plus demand to make bars and rounds, right? So even the decent size refiners, the big ones, they're getting loaded up on metal to make bars and rounds, even if they're taking in 1,000-ounce bars to do it, right? So let's say they have 50 million bucks in their warehouse. Now, when I use COMEX, I'm selling through my inventory, bang, 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 and replenishing. So I'm constantly getting money to cover my positions and to do all the things that you need to do to make this work. A refiner, on the other hand, takes all this stuff in, has to melt it down, pull out the impurities, turn it into what's called shot, they're little BBs, ball bearing size things that they can then melt down and turn into bars and rounds. Now, this whole process, especially when they're continually getting stuff in, could take weeks, 4, 5, 6 weeks of various stages of production. And they're hedged. They have to hedge that silver that they took in, they paid for from the public. So they got millions and millions and millions of silver inside the various stages of production that they hedged. But what's happening? Silver has been moving up so fast, and they're not pulling this stuff out or making the refined product fast enough. They're getting margin called. And they're like, oh my gosh, silver's going up. Our short position's getting margin called, just like these traders are. Pony up the money or your position gets liquidated. So they stopped taking new silver orders or refining orders weeks ago. And so this silver, months ago, this silver just sat there, where now the big houses are saying, fine, I'll pay you, $1.50, $2 back a spot in order to take it off your hands. And that's how it went. I went everywhere and bought all I could. And now you're starting to see it reverse again, because the demand always will catch up with these imbalances in supply. That's where we are now. So the premiums are coming back up. How long it stays here for, I don't know. But remember, during the pandemic, for 4 years, I would have paid you between $8 and $11 over spot for as much of this stuff as you would sell me. Just like markets move too far to one side and they swing back too far to the other side, we got to kind of find that equilibrium in a market like this. Who knows when or where that will be.
That's super fascinating to understand how the industry works like that. So, Andy, you were saying previously that you'd rarely, if never, seen the pendulum swing that far to the cheap side for junk silver, correct?
Yeah, and I never saw it swing that far to the expensive side for junk silver during the pandemic for 4 years. So yes, to be able to buy something below spot is ridiculous. Very, very early on in my career, I can remember in the 90s when silver was $4. Yeah, I might buy it at 10 cents back a spot, something like that, and sell it for 30 cents over spot or whatever the number was, but never to be able to buy it in dollars behind spot. Never. And to me, that was just silly to not. I literally told my operations, I don't care if you have to go on our line of credit, buy every single ounce you can find anywhere. Buy it all. Go to all the big houses, all the big primary distributors, buy everything, buy it all. There's no downside. We can melt it down if we have to. We have that capability in our warehouse. We have a smelter. We can melt it down and
that's cool.
Send it to the Royal Canadian Mint for pool credit. Whatever we want to do, we can do with that, but there's no downside. And I think that's what you're seeing right now. As the reason the premiums rise, it's what it costs to get it after you sell it. So if we sell out of this, how much does it cost me to find it and get it now? It cost me over $1 plus more than it did for the last 3 months on premium. And I think that will continue to move forward as these kind of values don't come by, but once every so very, very frequently.
Okay. Well, kudos for having the foresight to do that. Again, thank you for making the great deal you were getting available to this audience with letting them buy it for $1.
They'll say $1.35 over for now until that changes.
Okay. So folks, if you want to take advantage of that, same URL as before, thoughtfulmoney.com/buy-gold. There's a super short form there. You fill it out. It goes to Andy and his team, and they'll be in touch with you right away. Obviously, if you want to, if you've got other questions about precious metals or other buying needs or questions, they're happy to help you with that as well. And Andy, I'm just curious, given the current market dynamics, that $1.35 over spot that you're offering, that's still, in your opinion, pretty good relative to
ridiculously good compared to everything else. Everything. Okay. You look at silver bars, most companies are out of stock of them. Why? Because of tariffs. No one imported them. The majority of them come from Switzerland, Valcambi, PAMP, metallurgia, something, I forgot the name of it. Doesn't matter. There are 4 or 5 very large refiners in Switzerland, PAMP, Valcambi, Argo Harris. There are a few others. And then, of course, the Royal Canadian Mint. And for quite some time, no one imported them because the threat of tariffs. And so bars, which are normally really cheap, aren't really cheap anymore and are hard to come by and are largely out of stock. And so, yes, when you look at the difference between junk silver and the next cheapest thing, which might be a silver round, it's still an amazing deal. It's by far the best value in the industry right now. Okay.
All right. Couple questions. One, for junk silver, as prices get higher, silver kind of comes out of the woodwork. The grandma's silverware, the tea set, the candlesticks, but also junk silver, right? And it gets sent to the refiners. Now, there's technically a finite amount of junk silver in the world. Over time, years, maybe decades, should you expect kind of the premiums on junk silver to go up simply because it's becoming a scarcer and scarcer thing to find?
Yeah, I would think so. And because it can't be reproduced. I mean, you're talking, it's a minimum of 59 years old. And is that right? 60 plus years old. Yeah, I mean, minimum. And so, yeah, you're talking something that has scarcity built into it just because it can't be reproduced. Some of it gets melted down. Yes, I would think so. I mean, look, when you talk about the amount of investable silver, there's a very small amount of it available. And people in this industry think very much like, well, it's I can still buy it. The online, it's plentiful. That's BS. It's not. There's so much money out there that is wrapped up in traditional forms of investment. If 1% of it leaves those traditional forms and comes into this industry, overnight it will overwhelm the industry. There will be nothing left. Nothing. And I do believe that. And what's really different now is you're beginning to see silver and gold take a different view globally as something that is probably worth more than the dollars and the currencies that are used to purchase them. It is a race. This isn't about 2 or 3 brothers trying to corner the market in 1980. This is the realization, I think, that by sovereign nations that gold and silver are vital in every way to a thriving economy. Gold will be tied to the monetary system because the system has lost all trust. It will marry, I believe, to blockchain technology. And silver, the reason, I think when you think about silver, think of it this way. Why? This is the only question. Why have 8 banks in the West? 5 in the United States, 2 or 3 in Europe, and maybe 1 in Canada. Why have they controlled the largest concentrated short position of any of the 1,000 commodities traded on COMEX ever in the history of the COMEX? Why have these banks done this? Why? It's a tiny little market. The question isn't that they did it, it's why have they done it in silver? Unlike any other market traded in commodities, the largest concentrated short position in any commodity ever traded in the history of the COMEX has been in silver. The Western banks have had a vested interest in stepping on the price. It has never been allowed to find real price discovery. The nations in the global South understand this. That's why they have, the name of my podcast, Little by Little. They're smart. Everyone's, why don't they just buy it all? Because you cut off your nose immediately to spite your face and the whole thing blows up. But if you do it quietly, don't. Little by little by little by little, stand for delivery all over the world. Don't tell anyone about it. You're China. You go to Latin America and buy all the Doré and the concentrate. Don't tell anybody. You continue to do this and doing it in the Globex market, which gives you access to the COMEX through sovereign wealth funds, through proxy banks. So it's not the PBOC doing it. If the People's Liberation Army accumulates it through a fund, that's not reported. All of these things are being done covertly and quietly, and it's finally starting to come to the surface. And you get the U.S. say, well, it's a strategic mineral. And China's saying, that's right, and we're not going to export any anymore through massive restrictions. Some will come out, but not much. What we are seeing I believe, is a transformation back to, they say history doesn't repeat, but it sure rhymes. Gold and silver have been money and part of the monetary ecosystem for 6,000 years. It's coming back into play. And I think that when you look at silver from that perspective, the price doesn't matter today, but the big money that's involved in it, they're going to do everything they can to make you think, why am I holding this? It's too scary. It's over. The top is in. The mainstream media will do that. They've done it the whole way, and they've never been right. And all of a sudden, what do you know? Here it is at $70. Yes, it's going to be volatile. But in the end, I think it is nowhere near its final chapter is where this ultimately goes.
Okay, good. And I'm going to keep chipping away at that in the remaining time we have. A couple quick things. And one, just to finish the point, I'm not trying to push this. I'm just trying to see if my brain is actually thinking correctly here. But, junk silver, it's called junk silver, referred to as junk silver because it is kind of the cheapest, easiest way to buy silver right now. But it might over time become scarce enough that it is no longer the cheapest way to buy silver because these coins just go away because they're getting, a certain amount of them are getting melted down every month. Again, if you're sort of playing a long game and just trying to accumulate ounces from here, this may be a good way to buy low and then have the appreciation of the scarcity be a tailwind to your holdings over time. Again, not going to happen tomorrow, not going to happen next year, but maybe over the next 5, 10, 15, 20 years, all of a sudden junk silver is like, oh, I'm going to pay more for that because there's less of it around.
It's as disrespectful as calling someone born with red hair into a second marriage stepchild, a redheaded stepchild. It's just as disrespectful. It's wrong. It's not junk. It's just pre-65 constitutional silver. The reason it used to be called that, I started doing this, silver was $3 and $4 an ounce, and no one wanted it in the 90s, right? And so it meant that it had no premium. Yeah, I could buy it at 10 cents back a spot back then, maybe something like that, barely back a spot. But it just meant that it had no premium, and it's a name that has, in the very woke world what we've lived in the last several years, that name wouldn't fly, right? It's very prejudiced to its real value, and it's not right.
It's microaggression. It's
that's what it is.
Misgendering, mislabeling silver.
That's what it is. In a funny sort of way, it's the exact same thing. It's not. It's constitutional silver that has 90% silver. Now, people never really understand what that means. It just means 90% of its weight. In $1,000 face value, if it were uncirculated, there would be 723 ounces of pure silver. But the industry will guarantee 715 ounces. In other words, they say up to 8 ounces could be worn off of 1,000 face through running through coin counters for 50, 60 years. It's actually probably almost exactly 720 ounces. But so, in other words, you take that and divide it out. A dollar's face is 0.715 guaranteed of pure silver, whether that be 10 dimes, 4 quarters, 2 half dollars, or 1 half dollar and 5 dimes, 2 quarters and 5 dimes, 2 quarters and a half dollar. Any way that you can make a dollar of pre-65 silver, anyway between dimes, quarters, and half dollars is 0.715 to 0.723 ounces of pure silver, period. And the 90% is just by weight because it was used as currency. The other 10% is alloy to give it strength so it doesn't get all goofy and bend and that kind of stuff.
Okay, so this just may be an inefficiency in the market here, folks,
Yes.
where it is just, sneered at a little bit more than it should be. And again, you're just going to have the mathematics of scarcity at your back over a long enough time frame here as more and more of this stuff goes out of the world because it gets melted down into a different form. Okay, so you were talking earlier too, little by little, kind of until the world wakes up and realizes this is a game of musical chairs, and then there's the scramble, and that's when things can go crazy in terms of silver price. That might be somewhat of what's going on here. Sounds like what you're saying, Andy, is probably to a certain extent, but you ain't seen nothing yet in terms of how crazy this could get. I do just want to reiterate the mining exec that I was having lunch with the other day. He was talking about the dynamics in the industry, and he was like, "Oh yeah, and well, I mean, now that Tether's in the space, and I mean, they're one of our backers now." He's like, a big part of running a mine in the past was securing the capital to actually continue exploration and develop the mine. So he had a lot of stories about mines that were selling for cheap because nobody had put any money in them for decades. And then once, a new CEO was able to raise enough capital, they could bring that mine back to life and realize a lot of value pretty quickly, right? He's now saying with Tether in the industry, man, you get Tether invested in your company. He's like, your capital raising needs done. Like it's a bottomless
Tether was
market.
at the Beaver Creek Mining Summit, which is the biggest mining summit in the country. We've talked about Bo Hines, who's the CEO of USA Tether, their new division, who was Trump's crypto czar. We've talked about what they will do with the interest on the stable coins. By January 1, 2027, we will all be moving money on the stablecoin network, a blockchain network backed by stable coins. Those stable coins then are backed by U.S. treasuries. The interest is not transferable. Tether keeps it. USA Tether will be the primary beneficiary of this. Tether already has over 14 billion in gold, more gold than anyone in the world except central banks. They're going to continue to buy gold and silver, which continues to devalue the dollar, continues to push these assets higher. These are all part and parcel, I think, of what they're trying to ultimately do. You're right. And you are beginning to see these kind of vehicles where it's not just the normal market dynamics. I think you can really see, and again, ask yourself, who's bringing in all this metal? As I mentioned, in December, there were 3.706 million ounces of gold that were delivered in December, plus 64.730 million troy ounces of silver. 64.730 million troy ounces of silver issued. But in the first 3 days of this new January contract, first 3 days, we've seen 4,249 gold contracts, 3,596 silver contracts. That's 424,900 ounces of gold, 17,980 ounces of silver come into COMEX in 3 days.
Wait. Now, 3 days of January is bigger for gold than the entire month of September? Did I take my notes right?
That was December. Okay. In December, there were 3.706 million troy ounces of gold in the whole month of December. In the first 3 delivery days of
January,
there was 424,900 ounces of gold.
Oh, okay.
So not yet.
Not yet.
And 18 million ounces of silver in 3 days. Now ask yourself, if a mint box of silver, which is 500 ounces, weighs 42 pounds, who's bringing in 18 million ounces of silver in 3 days?
Right.
But this is every single month. And to me, the biggest crime in all of this is, where is this moron Jim Cramer, and where are all these talking heads who are so intellectual and so invested in helping the public understand what's happening. Nobody is talking about this. I've been screaming about it. This is all you need to know, you guys. This is it. The most well-informed traders in the world here in the United States, you could argue that's Wall Street, are bringing in billions of dollars every month. Billions. I mean, in December, what is 3.706 million ounces of gold times 4,400? What's 3.7 million times 4,400? Your calculator will go nuts. What is it? It's into the billions. But this is every single month for 13 months now, since last November when he won the election. And that's all you need to know. The most well-funded and well-informed traders.
It's not just these big players that are buying, taking delivery and buying the minted ounces, right, or the smelted ounces or whatever you want to call them. It's also big players securing their ownership of the metal in the ground, right? That's what the Tethers of the world, now the Samsungs are starting to do, right? And so the point is you have kind of, almost almost price insensitive buyers entering the space now, because it's not about the price for them. It's about the actual supply of the metal itself. They need that. Well, some need it commercially, like Samsung does. And then others are aware of that and just saying, well, look, I want to stockpile as much of this as possible because the world is only going to want it more tomorrow than they want.
China's been doing it for 2 years. China's been buying silver and gold doré and concentrate for 2 years or longer, pre-production, pre-refining. It disintermediates the market. That's exactly what Tether is doing. They're disintermediating the market. My friend Keith Neumeyer told me a year ago, he said, maybe 2 years ago, he said that he was at a conference speaking, probably right as we were coming out of the pandemic, and saying, this is the first time I've ever seen auto manufacturers at the conferences I'm speaking at coming directly
for
to
folks who don't know, Keith Neumeyer is the CEO of First Majestic Silver, one of the largest pure play. Well, it's not quite a pure play, but one of the largest silver miners out there.
Yeah, as far in terms of pure silver, they are, I think, the purest of all of them. And that's only about 60% of what they do is silver. I'm pretty sure they are number one in terms of purest, which goes to show just how hard it is to mine silver these days. Of all of the 850 plus million ounces mined last year, only roughly 160, 70 million came from companies like Keith's. The majority of it, because it's depleting in nature, it's found up on top, like your skin is epidermis. It's found in something called epithermal near the top. So the big deposits are gone. It's mostly byproduct of copper, zinc, and lead, and they stumble across it. So it's becoming harder and harder and harder to find. But he said, yeah, they're coming right up to the conferences to disintermediate the entire marketplace. But that's what China's been doing. Sean Kuhn, who is the CEO of Dolly Varden, has told me this a year ago. Yeah, Andy, they're coming by the drove. They go to Mexico and Peru, number 1 and 3. China, number 2, largest producers of silver in the world. Buy the bars in doré form, buy the concentrate, a byproduct sludge, if you will, of the mining process, pay double what the West will, ship it back to China to refine it. It's the same thing that we see now happening. The big money is doing all they can, whether it be Tether or the Chinese or Samsung, and I'm sure there's a lot more that isn't getting publicity. They understand that this is a depleting asset, one that has, you need it, or you can't make your product, or you can't have an advanced civilization in AI, robotics, high-tech military, all of these things. And that's why Trump made it a critical mineral in my mind.
Okay, so a couple of recent geopolitical things to ask you about. One, China, one of the things people think that was driving the recent surge in silver was that China basically announced it was going to implement an export ban on refined silver. And I think you've told us in the past that China is the number 1 refiner of silver in the world. All that doré, everything goes to China, gets refined, gets shipped back out. China is now essentially slamming the window shut and saying, hey, any silver that comes in anymore is going to stay here, more or less. And I believe that export ban did indeed go into effect 2 days ago.
January
1st. Yeah. What are we seeing from that? Anything yet?
Well, I mean, we'll know more what's going to happen once the market opens up here in, let's see, what time is it? It opens up in 6 hours. We'll see what's happening. But I mean, I think, again, it just goes to show if you have nations that are saying, yeah, this is critical, and yeah, we agree, we're not going to send it out anywhere near like we used to. I mean, they will send some out, but they're the only, if you're not a state-sponsored refinery, you can't send it out anymore. And there were all these small mid-level refiners that would send all their stuff out. Not anymore. You have to have a certain amount, like you have to produce a certain amount, be proven for a couple of years, and then get a permit through Beijing. But the state doesn't want to send this stuff out. It's going to have an effect. They're responsible for 60 to 70% of all the world's silver refining, and a lot of that would make its way back into the Western markets. And so if there is hoarding here on COMEX, again, millions of ounces every month, millions of ounces. These people aren't letting it go. So once it comes into COMEX, where's it going? Who's standing for delivery? Who's taking it out of the COMEX? Yeah, it's a race, and it will. All of these things will add up. And the interesting thing about it is that people who listen to me and you and others in this industry, Vince Lancy, amazing, a lot of really smart, good guys out there that are telling us this, well, we're the pimple on the elephant's rear end. The big money, the rear end, they have no, or the elephant itself, rather, they have no idea what's coming. And that's the interesting thing, is that when you take a step back and realize big money always positions before the herd, well, you can see it. You guys have a front row seat to see it. What makes people who listen to you and others in this industry unique is they have open minds. But I guarantee you, a Christmas dinner or Thanksgiving dinner, they would have a very hard time speaking this way to their friends and their family because no one gets it yet. So you will see profound impacts. But by the time it's recognizable to the mainstream, it'll be far too late. Everyone will have been far too positioned. And what is left, the scraps, will be too far and too few between in order, I think, to make it realistic for those people to protect themselves, because it'll be too expensive, too hard to get, too long, too many delivery delays, etc. Public is just now starting to wake up. The retail business has picked up over the holidays. I wanted to take a vacation. I worked my ass off every single day. Our phones were blowing up, truthfully. And
with a lot of thoughtful money viewers, by the way, I just want to acknowledge that a lot of people have taken advantage of this opportunity you've made available to them.
Well, and I appreciate that. And I will tell you, there's some of the highest quality people that we've spoken to ever in terms of their intellect, their understanding, their questions, everything. It's been wonderful. And but I don't think that we've even begun to see where this is ultimately going to go. But I do believe that January in particular, they call it the January effect, where lots of money is being deployed. But because silver went so high, at the same time, the Bloomberg Commodity Index, they have to rebalance it. So some silver has to be sold by law, but that plays right into the hands of those that are coming in to buy it, plays right into the hands of the banks that want to scoop it up. It's going to be volatile. Don't get shook. It's going to be volatile, but come back and look at this mid-February, and I think things will start to make a good deal of sense.
All right. Well, Andy, we will continue to have you, return to this program with a regular cadence. Hopefully not for your schedule as much as I've been leaning on you of late.
No, I love coming on, and I'll always make time for you, Adam. I'm dead serious about that. One other thing I just want to hammer on for 1 second. When we see the institutions closest to the metal prioritizing control of deliverable silver, not promises of future availability. In other words, where JP Morgan and Citibank are the two biggest recipients of all of the silver that Deutsche Bank, they made Deutsche Bank give up. Now, normally metal would flow back and forth between the banks in Europe and the banks in the United States. Remember, Tom Luongo has this theory that Trump is out to get the European aristocrats, and he'll do it by exposing the European banks, including the Bank of England. Well, all of this metal is coming back. And when you see Deutsche Bank have to cough up all of this gold and all of this metal to, in particular, JP Morgan and Citibank, it's like they're cannibalizing each other, that this relationship, this unspoken relationship, is now breaking down. And I think that is a really, 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 really big deal. To to me, it's interesting because Citibank says it's for their house account. JP Morgan says it's for a client. Who's got that kind of metal?
Right.
Which clients want to take in this kind
who's
of
got
volume?
that kind of money? Yeah.
Yes. And so I just want you to understand that these banks never cannibalized each other. It seems like maybe, and they were either forced or willing to deliver to JP Morgan and Citibank. And the best way to say that is the smartest, best connected institutions in the silver market now want to hold the metal themselves right now rather than take the paper promises into the future. This has never happened to this degree. It just tells you that that's all you need to know going into this volatility. Hold tight, even shut off your darn computer, come back and look at it in February. You'll be probably better off.
Okay. So forewarned, folks, the roller coaster ride might get a little bumpy from here, but Andy's not, he's not worried. He thinks higher prices will be ahead once the dust settles.
Yes.
Okay, couple other things. So over the weekend, we've had the U.S. remove Nicolas Maduro from Venezuela, and Trump was pretty direct, saying, "Hey, big reason for this is they took, our oil infrastructure that we had in place down there, and we want it back." And obviously, Venezuela's, been a basket case in terms of oil production. They've got I do believe with oil, they've got the world's largest reserves, and yet they have done such a poor job of tapping them in recent decades because of the shortcomings of the type of regimes that have been running the country there. So obviously, big priority for Trump and America to say, okay, let's start getting that oil out of the ground better. Venezuela also holds a lot of other riches. They are one of the most rich countries in terms of gold reserves in the ground. Do you expect this over time to have any impact on gold and maybe silver as new supply comes into the market that hasn't been getting tapped over the past couple of decades? You're shaking your head. So, okay, let's
and they have other things, natural gas and all sorts of other things. But no, if silver's a strategic metal, if they get their hands on it, it ain't coming back. And you could say the same thing about Gaddafi, about Saddam Hussein. And what about the 12 billion in gold the Ukraine sold to fund the war? Where'd that go? You could say that's all perhaps coming back to the U.S. for strategic purposes. Yeah. And, when Trump starts talking about the Monroe Doctrine, I think he's saying it's not just, this is like a pushback to the BRICS in my mind. Venezuela had applied to the BRICS. It's not just about them. He came out, there's an article in Axios that says he just publicly issued warnings to governments of Mexico, Cuba, and Colombia.
It was pretty thinly veiled in his press conference that
yes.
they shouldn't rest easy. Yeah.
But I mean, I think that if they're going to come in and take this stuff, it's not going into the open market. It's going into the U.S. coffers, because I do think that is part of national security. Certainly silver is. And if Judy Shelton, who you and I have talked about a million times, is right, well, that's part and parcel of what Tether is doing to push the price up. You need lots of gold to back the treasuries. Well, that would make sense to me. It ain't going out into the marketplace. It's going to back a new system, I believe, a new monetary system. So yes, it will have impact in terms of how it would benefit the country that holds it, but I don't think that's going to be something that will be dumped onto the COMEX market or onto the LBMA for anyone who wants to buy it. No, it's just going to strengthen the position behind the scenes.
Okay. Good insight, and I'm just noticing comments. We get more comments than I expected in the live chat here about people saying, "Hey, thanks for sharing all that about the skin cancer stuff." So, fortunately, we've got some people that are going to go get tested, and we've got some people that actually
God bless
skin cancer survivors saying, "Hey, this is really important." All right, so let me ask you this, because you were talking about how by the time everybody kind of wakes up to this, the elephant the general public wakes up to the fact that, the silver stuff's a lot scarcer than we realized, and man, I want to get my hands on it now. And you think, it's going to be too late, more or less, by then. Back when gold was hitting its previous nominal high of 1900, so what, this was 2011. As it was racing there, there were cash for gold ads everywhere, right? Gold's back to it has recently hit an all-time high. It's a little off, but it got to all-time highs recently. Silver's going bananas. I haven't really seen those ads yet, and I'm curious when the silver gig is up, do you think we'll be seeing cash for silver ads everywhere?
You know, part of me believes that the majority of that stuff has already been sold along the way. And I say that to you from talking to people. Say, yeah, man, I sold that stuff a long time ago when it wasn't worth that much, and I dumped it. And maybe there just isn't as much of that out there anymore because, you know, people when gold hit 2000, I think people thought that's it, and it ain't ever going higher than that. Dump it now. And certainly when silver hit $50, it ain't ever going high now. Dump it. It's an interesting thought, but I haven't seen as much of it either. I don't know. I mean, I'll tell you that as someone who runs a precious metals company, we get very little in the way of people selling. Of course, we will always run a two-way market, but I would argue that the majority of that stuff that was in weak hands was sold a long time ago. Just my own personal opinion. But yeah, I mean, you should. Silver is becoming that valuable. You know, a tube of Silver Eagles, you know, something like this, it's 20 coins. It's not cheap anymore. It's, you know, it's $1,600. So it's not cheap. So yeah, I would think it should. And I'm sure you will see people that would be willing to and happy to buy people. So the only other thing too is that, you know, you can, if this were a tube of gold, it's $90,000. So when you talk about shipping large amounts of silver, it becomes a little bit more difficult and stuff. Yeah. But I mean, I don't know. Your question makes sense. I don't know how it all plays out. My guess is the majority of the stuff in weak hands has already been sold years ago.
Okay. A question actually for the audience here. I talked about that mine CEO I just met. He's very kindly offered to take me to his mine, which is actually one of the larger silver mines in America. And I, of course, jumped on the opportunity. So I'm going to go. I will bring my recording paraphernalia and try to sort of document it to sort of show you guys kind of how a silver mine operates, and also, you know, get the CEO interviewed a little bit so you can kind of, you know, see more specifically what's in his head about where he thinks the industry is going and stuff like that. If that would be of interest to you all watching, let me know in the live chat if you're watching live, or in the comments if you're watching the replay. Obviously, I like to do more of the stuff you'd like to see and less of the stuff you don't want to see. So if that is something that would interest you, then I'll prioritize hopping on this guy's corporate jet and going to his mine and documenting it all for you.
Okay, if you need a chaperone on the corporate jet to the mine, I'm willing to join you.
Is that something you'd be interested in doing?
Oh yeah, I think I know what you're talking about. I'm not going to guess, but I would love to. You need a chaperone? You let me know. I'll come anytime. Be happy to do so.
All right. Well, that would be really fun if we make it a bro trip to go to the mine together. All right. So I guess just getting back to the title of this live stream, Andy, which is, has the silver boom peaked out? You've already said, you know, from your perspective, no. You think it's probably going a lot higher, though the ride will be volatile. Let me just ask, I'm not going to hold you to this, but just sort of guesstimating, where are you sort of prepared potentially for the silver price to go in 2026?
I mean, let's be pragmatic. And I do have a hard stop in about 7 or 8 minutes.
We'll get you out.
So if we took gold right now at $4,330 and we divided by 42, which is pretty much the average man's price of the last 100 years, you're at what are you at? 43.32 divided by 42. You're at $103. What's interesting is if you take the 45-year cup and handle, the top in 1980 is 45. The bottom is around 4. That's $46 difference. Then you get up to 2011 where it's the top again. So, and then it comes down to the handle. And when it breaks through, you take the top minus the bottom. That's 50 minus 4, 46. Add it to the top. That's $96. Pretty darn close to where that number is. I would not be surprised one bit to see Keith Neumeyer's triple-digit silver prediction years ago play out. And quite frankly, that would just be the average ratio between the two for the last 100+ years. It could go much higher than that. If you realize it's coming out of the ground at 7-1, I'm not saying we're going to get to 7-1, but even take 20-1. Well, 20-1 right now at $4,332 would be $216. Could silver hit $200? Yes. Will it? Don't know. That's a lofty guess, but I think $100 silver is not foolish at all. I mean, at all. Not only is it the average ratio of the last 200 years, roughly 150 years, but it would still be about 6 times higher than it's coming out of the ground at.
Okay. And let me ask you this right now, given market conditions right now, if somebody they had a certain amount of money, $5,000, $10,000, and they wanted to put it in either gold or silver, which would you encourage them to put it in right now?
100% silver. 100%. Okay. Now, if someone had $10 million, it wouldn't be the same thing, because ultimately you want to continue to buy gold. Ultimately, when the music stops, it's about gold, in my opinion. But the value and the leverage and just the flat out, in my mind, best value I've ever seen, most undervalued commodity in the world is still silver. When the music stops, gold's going to be massively reintegrated into the system, and we're not getting any younger. So again, if this is $1,600, whatever, silver, but 90,000 gold, as you get older, moving, schlepping, storing, logistics with silver can become an issue. So I think you use that ratio. Now, when you and I started talking, the ratio was 85-1. Now it's in the 50s. It's averaged roughly 42-1 since the Industrial Revolution. Coming out of the ground at 6-1. You can see this trend disappearing in nature. Only 20% comes from silver miners, the rest byproduct. The trend is for a declining ratio. And then when that ratio gets anywhere 40 or under, you're supposed to switch to gold. So there will come a time to do that. Right now, silver, but could very shortly be gold. But value-wise, for 10 grand, you're just way better off having the leverage of silver versus 2.5 ounces of gold.
Okay. I'm smiling there, Andy, because somebody just put Andy Schectman for president 2028. So just know you got a lot of goodwill amongst the following.
Thank you. I appreciate that, you guys. I try hard. I do the best I can. Hey, saying these things, putting yourself out on a limb in front of the world is not as easy as you might think.
No, and you take a lot of things.
You want to be measured about it, for sure. I don't want to be. One other thing, and I've told you this before too, Adam. When I think it's time to sell, I swear to you, on the Bible, I swear to you that I will tell the world when I think it's time to sell. But I don't think we're anywhere near that yet. But there will come a time to trade your silver to gold, and I'll be the first one to tell you when it's time.
Well, I very much appreciate that. And on that question, Andy, so let's say there's somebody who has amassed a fair amount of physical silver. They're not storing it with you, though. If you're storing it at home, folks, you should store it. I highly recommend consider storing it with an organization like Miles Franklin, just for theft and loss risk. But say they're sitting on thousands of ounces of silver, and we get to the point where you tell folks, hey, you know what? I actually think the wind is now shifted, and you want to put your money more in gold. If somebody says, okay, Andy, I want to convert my several thousand ounces of silver into gold, can they do that through you?
Yeah, we'll make it very easy for them as well. We would help them get it shipped back with FedEx air bills. We would make nothing on the buying of the silver. There's no reason to steal from Peter to pay Paul, whether they bought it from us or not. We'll just make sure that we take all that credit and apply it to the purchase of their gold. So yeah, that's something we're very adept at. We'll help you from start to finish. If it's in a storage facility, it makes it even easier, of course, no mailing and schlepping. But yeah, we'll buy the silver, we'll switch it into the gold. Best if it's in an IRA too, no tax implications. Yeah, I think it's a trade of a generation. And so we will be all over that. I promise you. I've been talking about this since 2000. And you know the old statement that markets can stay irrational longer than people can stay solvent. I am shocked it's lasted this long, but you see it starting to trend back towards its historical mean. And the further you get from historical averages on anything, the greater the magneticism that drifts you back to the mean. It's called regression to the mean. We are regressing. There will come a time where I come on your show and say, now it's time to trade back into gold. And there may come a time down the road where it happens again, where you go back into silver. Anytime you're above 70, you're in silver. Anytime you're below 40, you're definitely in gold, or even 45, you're definitely in gold.
Okay, so if you're younger than 80 years old watching this, sounds like you're saying, Andy, folks, think of this as a game of innings. And, there are going to be some innings where you're going to want to be fielding your gold team. There are going to be some innings where you're going to be fielding your silver team. And part of your job as a long-term precious metals investor here is to kind of know when it makes sense to have which team on the field.
Yes, very much so. Very much so. And speaking of teams on the field, I am going to have to, unfortunately, I'll always stay on these long, but I have
we'll let you go. I know you got
family member golf tournament in my backyard, and I live on a golf course, and they're probably all ready to tee off. But I'm going to come in there not warmed up and whoop them all. So, but I appreciate being here, Adam, more than you know, and I will always be here when you need me. And I'll always shoot from the hip. I want to wish you and everyone else a very, very, very happy, healthy new year. I'm happy to pick up as soon as you want to where we left off. I'm sure there'll be a ton to talk to about over the next couple of weeks. Please don't be bashful. I love doing this, and the live streams are the best form. So something crazy happens over the next few days, I'm willing to jump back on and chat about it.
I so appreciate that. Yeah, I think the odds of something crazy happening are not low. So we'll see what happens there. But importantly, let's let you hop off, Andy. Go beat the pants off the rest of your family. Thanks so much.
I got to do. And they all leave. They all leave in the next day or two. So I'm gonna get in big trouble by my wife if I'm not on.
Go ahead and invest in the things that matter. Folks watching, stay on for another 60 seconds. I'll do some quick wrap up here. But Andy, thank you so much, my friend.
Take care, brother. I'll talk to you all soon. Thank you. Happy New Year.
All right. So, folks, a couple of things. Andy's going to watch the replay. Do me a favor. Just thank him in the replay. Let him know how much you enjoy both him coming to share his insights, but also taking the time again during the holidays to do this for us. Just a reminder, if you want to take advantage of that offer that he is offering to the Thoughtful Money audience, just go to thoughtfulmoney.com/buy gold and fill out the short form there, and you'll, like I said, be in direct touch with Andy and his team there. And do me a favor, if you have enjoyed this live stream with Andy and want to see more of these, just let me know that by hitting the like button, clicking on the subscribe button to this YouTube channel. If you haven't done so already, don't forget to click that little bell icon right next to it so you get alerted of new videos in the future. And again, I read all the comments that get that you all share here in the live chat and in the comment section below. And so if you want to see more of these, if you want to see that mine tour that I mentioned, or if you want to see other things that I haven't mentioned but are on your mind, again, just let me know in the comments and I will read them and take them into consideration. Great way to kick off 2026, folks. Thanks so much for joining us on this Sunday live stream. Have yourself a wonderful new year. And as always, thanks so much for watching us here. Take care, everybody.
That we're still at above 2.5%, close to 3% in the U.S. inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon. And this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980, but far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the endgame investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the videos so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price, but this is of course not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension, and then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate, inflation I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate. And you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate. And the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up, blah, 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 blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising, they were rising and rising and rising, and so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the U.S. inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing. And it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
I think we've got another 5 to 10 years in gold.
Best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Gold and silver remain in a long-term bull market, driven by central bank buying, ETF accumulation, and rising debt that prompts investors to seek inflation hedges. While gold still has another 5 to 10 years left in its bull market, analysts like Mario Innaco and Clive Thompson believe prices will continue to climb until a major crisis, whether driven by monetary, geopolitical, or systemic forces, forces a reset into a new currency system. Until then, market sentiment suggests continued gains and a potential final explosive rally within the next decade. The speaker, Mario Innaco, a financial market expert, mentions that Bert Doman, founder of Doman Capital, conducted a long-term cycle study of gold reaching back centuries. He identified a 20-year bear market that started in 1980, which ended around 2000, followed by a secular 30-year bull market that began in 2001. Based on this, he believes the current gold bull could continue through 2030 to 2031. The narrative of a prolonged upward trend amid systemic financial pressures finds strong consensus among many observers. Based on this, it is concluded that gold still has another 5 to 10 years remaining in its bull market. Clive Thompson notes that the bull market in precious metals is likely to continue until a new dollar, pound, or gold-backed currency, or a central bank digital currency, replaces the current currency system. Until then, rising government debt and recurring monetary, bond, or geopolitical crises will continue to drive investors toward inflation hedges. The excerpts from the interview are now available. Please click the bell symbol to receive timely updates, and subscribe to our channel before we continue our conversation. Thank you, and have fun watching the video.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market. Why do I say that? Well, I listened to Bert Doman. He's a fund manager, and I think he started out in the 70s. He's originally from Germany, but he's US based. And he said that in the 70s, he got his clients into gold in the mid-late 70s, and they did very well. And then in 1980, he told them, you need to get out of gold. We're going to have a 20-year bear market. And everyone thought he was crazy, but he was right. And then he said, but after that, there will be a 32-year bull market. And I think he looked at the price of gold going back a few hundred years in the UK, because the UK and the US are linked, the prices. So if you add 32 to 2000, you get 2032, and that's why I'm looking for another 5 years at least. But I think Jim Sinclair used to say that the next move higher in gold, let's say, it's not going to be like in 1980, because we went up to like almost 900, and then the next 20 years we drifted between 250 and 400. He thinks it's going to stay up there next time. It's going to be different. So I'll let Clive answer that.
Well, I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along, and they'll be pushed into a situation where people are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description, or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency, where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher, because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Rafi, in the interview with Clive and Mario, recalls that the gold to CRB ratio indicates gold's value relative to other commodities. Since 2000, it has been in a clear bull trend, despite occasional pullbacks. The 2020 oil crash, when prices briefly went negative, sent the ratio into an extreme spike. However, since gold and silver bottomed in 2022, the ratio has been climbing again. Currently, the chart suggests we're halfway through this significant upswing. Unlike during the lockdowns, oil and other commodities are not depressed. Yet, gold is still rising strongly, indicating solid momentum in its ongoing bull market. However, Mario, along with Clive Thompson, notes that with the global adoption of Basel III capital rules now underway in the US, allocated physical gold is formally recognized as a Tier 1 asset, on par with cash and treasuries. This institutional shift underpins the demand for gold, reinforcing its status as a financial backstop amid potential changes to the monetary regime. Governments are rapidly developing central bank digital currencies. The EU is fast-tracking its digital euro proposal to counter the growing dominance of US-linked stablecoins, while China is expanding international use of its e-Chinese yuan, and considering yuan-backed stablecoins for cross-border trade. The UK is also developing a digital pound, with consumer usage expected in the late 2020s. Now, let's have an insight into the interview.
So this is the gold to CRB ratio. All right, so it goes back all the way to 2000, but I picked 2010 here just so you could see.
Yeah.
This is if we're in a gold bull market, then this is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to negative 35, so that's why it went so high
Yeah.
here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Well, we do take long-term mortgages, but the rates are set short-term, like 2 and 5 years. So they are based on the like 2-year swap rate, they call it, and the 5-year. But I think long-term rates, they've been going up a lot. They're making like highs, 27-year highs, like the 10-year, well, the 30-year yield. And what that will do is that's going to hurt the government. That's going to increase the deficit. That's going to inflate things even more. And I think the Bank of England is going to have a tough time cutting the short-term rate. So even though in the UK we don't use the 10 and 30-year rates to set mortgages, I think things are going to remain tough. Clive?
Well, banks, when they lend money for a mortgage, whether it's in the UK or any other country, they are effectively lending that money out for the next 20 or 30 years because they're not realistically expecting anyone to repay the mortgage in the next 6 months. So, of course, long-term rates have to have an effect on the interest rate they're going to charge you on the mortgage. Yes, there's an influence in the UK because they set the rate in some way to the 2 or 6 or 5 year term, and then it gets rolled over at a higher rate regularly. But at the end of the day, if long rates are pushing higher, the banks have got to have their heads screwed on and say, well, we've got to charge our customers a little bit more because at the end of the day, the alternative, we don't have to lend the customers the money on their mortgage. We could go and put the money into a 30-year bond, which is effectively the same thing, instead of lending it to my customer. So if the 30-year bond rates were to go to, say, 7%, you won't be able to, I don't think you'll be able to get a mortgage for less than 7, for sure.
Rafi, you got an opinion on that?
Yeah, so what Clive is saying makes logical sense. If a bank can lend the money to the government with much less risk than it can lend to somebody for a mortgage, with a much lower default risk to the government, obviously, then whether 30-year mortgage rates officially set mortgages or unofficially doesn't make that much of a difference. It makes a little bit of a difference maybe in short-term fluctuations and stuff, but there shouldn't be too much of a spread between 30. I mean, there shouldn't be more 30-year mortgage rates shouldn't be substantially lower than 30-year bond rates. It shouldn't be lower at all, but if it is lower, it shouldn't be that. It definitely shouldn't be that much lower. So yeah, their mortgages are set by long-term rates, either formally or informally.
Gold and silver remain firmly in a long-term bull market supported by systemic pressures, central bank accumulation, and the institutional recognition of gold as a Tier 1 asset. With CBDCs on the horizon and financial uncertainty growing, precious metals are positioned not only as hedges but as anchors in a shifting monetary system. Meanwhile, miners' renewed strength suggests the bull market is still in its early phase, with significant upside potential if gold prices hold above current levels. Do you think the rise of CBDCs will accelerate demand for physical gold as a parallel store of value? Could gold miners finally see a sustained re-rating, or will they continue to be a niche play despite strong fundamentals? Please feel free to express your opinions in the comments section below. If you found this helpful content, Please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
I think gold is going much, much higher. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And as I just said, $35,000 per ounce. I mean, that's the highest numbers we have heard of gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122.
You can't get rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seeberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Seeberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Seeberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate, and because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the US point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40, 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly, for those...
Hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to... What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's why
I think it's ultimately...
That will absolutely unload everything into wherever the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I think
I don't think it
telling
tops
people-
yet. I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that.
Yeah.
Everything is
Who's
overvalued.
selling the gold and who's buying the treasuries?
But it's not.
Who's
It
the
will be
idiot
about.
trader?
Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was. It was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
That's retail.
leveraged.
That's not central.
No.
That's
But
this is good. This is
Exactly.
good.
But it can-
this is good because it's
can be
important to have a disagreement on
corporations
the
as well.
DXY. We agree on
What
gold,
we're
but
actually
this,
saying is crypto kiddies that are losing money on crypto who happen to be big gold holders are now going to be selling their gold and they're going to crash the gold market in an environment where the
It can
central
also be
bankers are
sovereign
not
state.
setting
It
the
can also be
price.
sovereign nations that can be a problem. It can get a problem if you start to see that they're, the
They'll
yield
do
levels are
swaps.
specking off.
but Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. Treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold, and the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what
will
happened
forced.
in 2008. I'm just trying to find.
Arguably,
Yeah,
which is the
arguably.
35%
But
decline you
unlike
had
2008, I'm just trying to. I'm not saying you're this isn't a foolish argument.
No,
you're
that's
making.
fine. We just
Unlike
discussing.
2008, though, today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08?
Henrik suggests gold isn't in a bubble but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the U.S. dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that.
Mm-hmm.
And we also know that normally when we have a real gold bull market, we'll see silver follow.
Mm-hmm.
Silver is not at all-time highs yet. And there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. that tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to
different
see
point.
a
I
decline.
also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it
No,
just
I don't see
doesn't
it
make sense.
being a big
It
one.
doesn't make sense. It doesn't make sense that, but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here, because everybody's been talking about inflation and how debt is a problem, and that debt is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the DIX is going to, when we go through this whole shit.
There's an industrial component to silver,
Okay,
number one. And
that's my perspective.
I get your perspective, Henrik. I get your
That's my perspective.
And hyperstagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very
a
low.
number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. Gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off, because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? You still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No. I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, guys, I know the saying of the institutional adaptation and all these things, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt? Yeah, but this is the gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s
No,
high.
I'm not.
This is adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.